What we're now seeing, I think, potentially, is a crisis in Western markets whereby the credit system has entered into gold commitments which it cannot deliver. And what that means is that the value of the dollar, the purchasing power of the dollar, is going to decline even more rapidly.
If the public is not buying gold, you may wonder, how is it that the price keeps going up? Somebody's got to be buying. In fact, somebody has to offset all of the selling. And that is the institutions or the smart money, the big buyers, and the central banks. Foreign central banks are buying up gold. They want to get rid of their dollars. They want to divest and move out of the dollar. And so the best alternative to the dollar is gold, and that's what they're buying.
The world is continuing to ditch the US dollar and is replacing those paper dollars with hard assets. This shift is not happening overnight, but results from years of declining trust in the dollar's stability, driven by excessive money printing, rising debt levels, and geopolitical uncertainties. Once seen as unshakable, the US dollar's strength is now questioned more than ever. As governments and private investors seek to protect their wealth, gold has emerged as the most reliable store of value in uncertain times. Investors are flocking to the precious metal, viewing it as a secure investment amidst growing financial volatility.
Part of the problem is that nobody actually understands money. They don't understand that everything is credit other than gold. And we've had 50 years of propaganda from the US Treasury saying that gold is no longer part of the monetary system and the dollar is now money, which is pure propaganda. But people tend to believe it. So it's a long, hard battle getting people to understand what is actually going on. You've got the debasement of the currency. To give you an idea of how bad it is in the UK, bear in mind that in 1932, before the second attempt at a gold standard was abandoned, one gold sovereign coin was worth £1, and you could exchange it at the Bank of England for £1. So you take your £1 note and you exchange it at the Bank of England for one sovereign. And you could do that on demand. That was the whole point about the gold standard. So that was 1932. Today, the value of a sovereign is over £540. That gives you an idea about the debasement of sterling credit over the last 90 years. Now, it's a process which is now accelerating. So, and this is an important point. People think, okay, we see prices rising and all the rest of it. Inflation's what? CPI is what, 2.3% or something. For a start, you can't measure the debasement of a currency that way. The only way you can measure the debasement of a currency is by comparing it with real money, which of course is gold. And we've seen in 2024, we've seen that the purchasing power of the dollar, measured in real money, which is gold, has declined by over 25%. That is an acceleration on the previous year. What we're now seeing, I think, potentially, is a crisis in Western markets whereby the credit system has entered into gold commitments which it cannot deliver. And what that means is that the value of the dollar, the purchasing power of the dollar, is going to decline even more rapidly, because people will want out of the dollar and into real money. And then there's a further problem, because as soon as people start really doing that in earnest, you've got all the debt that needs to be rolled over and nobody to buy it. So what happens to the value of that debt? Well, it goes down. In other words, the yield rises.
One of the primary drivers behind this movement is de-dollarization, the process by which countries reduce their reliance on the US dollar for international trade and financial transactions. This trend is gaining significant traction, especially among the BRICS nations, Brazil, Russia, India, China, and South Africa. These countries have been at the forefront of efforts to break free from the dominance of the US dollar. The BRICS nations are exploring alternative trade mechanisms, such as using their local currencies in cross-border transactions, to establish a more independent and resilient economic framework that isn't tied to the fluctuations of the US dollar. This shift is a direct response to the growing unpredictability of the dollar and its decreasing value as a global reserve currency. As the BRICS nations continue to push for this shift, the U.S. government has responded with strong opposition, making it clear that it will not let the dollar's dominance slip away easily. President Donald Trump, a vocal critic of these developments, has made it clear that he will not let the U.S. dollar's dominance be threatened. Trump recently warned the BRICS countries of severe economic repercussions if they continue to pursue de-dollarization. According to NDTV, he declared, "The idea that the BRICS countries are trying to move away from the dollar while we stand by and watch is over."
And if the BRICS nations want to do that, that's okay, but we're going to put at least a 100% tariff on the business they do with the United States.
He further threatened that if these nations attempted to create an alternative currency or support another currency to replace the US dollar, they could face crippling tariffs on their exports. The statement highlights the dollar's importance to the U.S. economy and the political will to maintain its dominance on the global stage. Amid escalating political tensions regarding the dollar's future, the surge in gold prices over recent months signals how investors are adapting to these economic shifts. Gold has been hitting record highs, recently touching $2,885 per ounce. This surge can be attributed to several key factors, including fears of trade wars, inflationary pressures, and rising geopolitical tensions. Of particular concern is the recent introduction of tariffs on Chinese imports to the U.S., and the hint of the implementation of tariffs on European goods, which have kept markets rattled, with investors on constant tariff watch.
U.S. President Donald Trump has kicked off a trade war with one of America's biggest rivals, China. While Donald Trump planned to impose 25% tariffs for Canada and Mexico, China faced only 10% tariffs on its imports.
The rise may also have been propelled by President Trump's statements, indicating that he was not rushing to speak with President Xi to avert an upcoming trade war with China. However, this time, it appears that Western investors are turning to the real thing instead of opting for paper gold. Additionally, before President Trump announced the suspension of the 20% tariffs on Canadian and Mexican imports, gold prices had already reached record levels, surpassing the $2,800 mark then. This shows that, despite political efforts to manage the economic landscape, the growing uncertainty surrounding trade policies and currency stability is pushing investors toward the security of physical assets like gold. This demand comes from private individuals. Central banks, particularly in emerging markets like China, Russia, and Turkey, are ramping up their gold reserves. According to the World Gold Council, global gold demand reached an all-time high of 4,974 tons in 2024, underscoring the growing reliance on gold as a safe haven asset in a world where trust in fiat currencies is eroding. This shift away from the US dollar is evident in the surge of gold purchases by governments and private investors alike, all trying to hedge against the risk of currency devaluation.
Gold, in my opinion, is going to keep moving up. The dips are going to be short and shallow, and so there's no point in waiting for them. You're far more likely to buy higher than to buy lower. We're still early, really, in this phase of the bull market. You know, the last big bull market that we had in gold was from 2001 to 2011, and gold went from a low of about 250 up to a high of 1900, about an 8-fold increase. Well, then we went into a big bear, and gold pulled back from 1900 to 1050 in 2015. We've been going up ever since. But if this bull market is going to equal the leg in the previous leg, you're talking about $8,000 gold. That's 8 times 1,000. Now, I think that gold's going a lot higher than 8,000. But even if it only went to 8,000, that's a pretty big move considering we're still below 3,000. So you don't want to wait. You have to resign yourself to the fact that you're going to buy the high. And if you want to buy more gold, which, I would advise over time, you better get used to buying the high because that's what you're going to do. And the longer you wait to buy the high, the higher the high that you're going to buy. Now, eventually, right, you're going to have a change of heart. The public is going to wake up and start participating. If the public is not buying gold, you may wonder, how is it that the price keeps going up? Somebody's got to be buying. In fact, somebody has to offset all of the selling, and that is the institutions or the smart money, the big buyers, and the central banks. Foreign central banks are buying up gold. They want to get rid of their dollars. They want to divest and move out of the dollar. And so the best alternative to the dollar is gold, and that's what they're buying. But it's not just the central banks. I've noticed that there was a big increase in delivery notices, first at the London Metal Exchange and now on the COMEX. And what that means is that people who own gold futures contracts are letting the counterparty, the short, know that they want delivery of their gold. They're not going to cash settle these contracts. They're not going to roll them over. They want the actual gold behind the futures contracts. Now, these are not small investors because a minimum, you've got a 100-ounce bar. So these are big investors who are intending to take delivery of their gold. They don't want to gamble with it anymore. They actually want the physical metal. Now, this could be the beginning of a major short squeeze in gold as they have to replenish those stocks and they may run out of gold. And it may be impossible for some of the shorts to deliver. And now they have to go into the market to buy the gold that they sold that they never had. So we can start to see some real fireworks in the price of gold. I think it may begin when the price of gold is above 3,000, which is why I'm saying don't wait for 3,000. Buy it now. Buy it before it gets to 3,000.
Many analysts predict that gold could continue its ascent, with some forecasting that the price could surpass $3,000 per ounce by 2025. Several factors contribute to this expected rise, including inflationary pressures from expansive government spending and aggressive tariff policies. Moreover, if the Federal Reserve decides to lower interest rates to support economic growth, the US dollar could weaken further, making gold an even more attractive option for wealth preservation. This environment of low interest rates and inflation will only fuel the demand for gold, further propelling its price to new heights. So, what does this mean for you? If you're concerned about the financial system's stability over the long term, now may be the time to consider diversifying your portfolio with hard assets like gold. Do you think gold will continue to rise, or do you believe the US dollar will manage to maintain its dominance in global trade? Let us know your thoughts in the comments below. If you found this video insightful, be sure to like, subscribe, and share it with others who need to stay informed about these critical market shifts. Your support helps keep this channel running, and together, we can continue to explore and understand the forces shaping our financial future.